So we're going to take a look at TPG, and this is a REIT. And what we're going to do is we're going to value the company. I'm going to take you through the process step by step. And we're going to enter financial information into our cash flow model. And then the model will calculate the future free cash flows of the company. And then we're going to discount those cash flows back to today's dollars. So we have to figure out the discount rate to use. And then we're going to compare the stock price, the intrinsic stock price, the price we're going to calculate, to the actual stock price it's trading at, and see if the stock is a buy or a sell. And then at the end, we're going to look at the financial ratios and compare it to other REITs and see how this company performs. So TPG, first we need a market cap. I remember when I was working on Wall Street 20 years ago, at JP Morgan, one of my co-workers went to work at TPG. So for the model, we need the market cap, which is 738 million, and then the stock price, which is 963. And we're just pulling that off of Yahoo Finance. And now we can calculate the stock price, the shares outstanding, which is market cap divided by stock price. 77 million shares outstanding. Next, we need the free cash flows, and that's also in Yahoo Finance. And you just go to the cash flow section, you pull that number in. And I put some notes. So if you wanted to calculate free cash flows, it's just operating cash flows minus capital expenditures. And if you see a positive free cash flow, that means a company is adding value to its investors. It's increasing its assets. And if you see a negative free cash flow, it's decreasing value, and it's going to have to borrow more money in order to just operate its day-to-day business. Now let's get to net income. That's what we call the profit and loss for a given time period. And this is used in the model, but we don't forecast net income. We forecast free cash flow to figure out the value of a company, because that's what people invest in. Think of it, if you had a business, you would want to know the cash it generates. And it is possible to have positive free cash flow and negative net income and vice versa. In this case, they have positive for both, so that's a good sign. It makes it a lot easier to calculate their value of the stock if the numbers are positive. If they're negative, it could make it really difficult or impossible. Now let's get the revenue for this company, and we pull 4 years of data, and that's what we need in our model. And it calculates the future free cash flow based off of those inputs. And we need a capital structure of this company because everybody pays a different interest rate. Just like I pay a different interest rate on my mortgage than you do because I have a different credit than you. Same with the company. Everybody has different credit. So let's get their interest expense. This is the interest they pay on their debt, $175 million. And they don't list the debt in Yahoo Finance, so I had to go to the 10K. I don't have it up, but I had to go to the 10K to pull see how much debt they have, and it's 4.3 billion. So we calculated the interest rate at 4.11%. And REITs don't pay taxes, so we don't have to discount that interest rate. So the cost of debt is 4.11%. So 85% of the capital structure is debt, so it's really leveraged company. That's not a good sign. I generally don't like to invest in companies with more than 50% debt. Now we need to figure out the cost of equity. And look how low the beta is. That's really surprising, so much debt. So 0.36 beta. So beta is the volatility of the stock. So a beta of 1 means the stock moves with the market. In this case, they have a beta of 0.36. So every time the market goes up $100, this stock goes up $36, or 36% of the market increase. So the cost of equity is 5.1%, and that's using the CAPM, capital asset pricing model, and they used beta for that. And the cost of debt is 4.11%. And when you combine these numbers together, you get the WACC, the weighted average cost of capital, and that's 4.25%. And that's what we're going to discount the future cash flows by. So we get a value of the company of $17.58. So it's trading at a 45% discount. So according to the model, it's a buy. So let's look at historical. That's interesting. So historically, it looked like the price was closer to about $20 for a really long time. It looks like forever. And then it dropped once coronavirus hit, and it hasn't come up too much, a little bit, since the drop. So it is trading at a discount. But keep in mind, when stock prices are not always based off of what the company's worth. It sounds like that would be logical. You would pay what it's worth, but that doesn't happen in the stock market. You pay based off of supply and demand of the market and what others are willing to pay. Other investors aren't willing to pay $17 for the stock. They're willing to pay $9.63 at this point, because more people sold the stock. That drove the price down until you finally found a point where someone was willing to sell it at that price. Because if somebody had the stock at looks like about $21 at this point, and they were trying to sell it, nobody was interested at $21. So you had to find a point, and somebody says, okay, I'll take it for 20. And then the next person says, okay, I'll take it for 19, and it drove the price all the way down to $9.63. So the biggest indicators of a stock price are fundamental factors like earnings, what we went through pretty much, the fundamentals, which is what I like to value stock on. But it also works, stock price also is affected by technical factors such as the price history of the stock, also external things like inflation and competition. So even if a stock is worth $18 and there's like Trump said, all REITs are going to get taxed 100%. Like, doesn't make sense, but so nobody would buy REITs and the price would go down. So external factors play a lot into it. And what's even the most tricky to figure out, especially times like this, is market sentiment. What people feel about the stock market and the future of the economy and all those things. And no one can predict those factors. It's just how people feel and react to things. So with all that in mind, you have to understand that when investing. And I think the only way to mitigate these types of things is to hold stock long term. That's the only way to minimize these things. Because over time, stocks will go up and down. But if you pick a company with solid fundamentals, it will go up, but it could take a long time. In certain times, it took years. During the Great Depression, it could have took a decade for certain stocks to go back to where they were. So you have to pick the right stocks and wait and not let the market affect you emotionally. Now let's look at their ratios, because a lot of people don't have a discounted cash flow model they can run. And I do think this is the best way to value a company, but ratios is what a lot of people look at. I already input the current assets, current liabilities, and equity because it wasn't in Yahoo. I had to go to the 10K for that. So I input it already. I usually input it during the video so you can see how I do it, but I didn't want to sift through the 10K during the video, so it's over there. But the current assets, just so you know, it's $5.9 billion of their current assets. And it's pretty much assets that are expected to be sold or used within 12 months. So it's not something like a printer, because that's something that's probably going to keep for a long time, unless you sell printers, of course. But current assets are things like cash. You're going to probably be using your bank account a lot to buy things. So the most common current assets are cash, accounts receivable, what people owe you, and inventory, if you do have inventory. And current liabilities is $4.4 billion, and that's the short-term obligations, and that's due within 12 months. And the most common are accounts payable is what you owe people, like you may owe a supplier or vendor if you buy on credit, which a lot of people do, or short-term debt. Those are the most common types of current liabilities. And equity of $1.5 billion, and equity is on a balance sheet, and it's just total assets minus total liabilities. So it's just the value of the company. according to the balance sheet. And it's also known as different names like shareholder equity, owner's equity, book value, net assets. Those are all equity. They mean the same exact thing. And you could think of equity as the money returned to shareholders if all the assets were liquidated and all the debts were paid off. So if all your assets, the 5.9 billion, if we turn this into cash, we can't turn it all into cash because inventory, we might not only get half price for it. So we might only end up with $5 billion after we sell everything. And then we'd have to pay down on liabilities, the 4.4 billion, and whatever's left over is the equity, is the value of the firm. But look at the balance sheet, because there could be things on the balance sheet like inflated assets or intangible assets that might not be worth as much as the balance sheet indicates. So let's look at the actual ratios. These are really important for any investor. So the PE ratio is the most common. That's the price of the stock over the earnings per share. And you want a lower PE ratio. I like to see under 15 when I invest in a stock. And so in that case, they have a really nice PE of about 6. So that means investors are willing to pay $6 for $1 of profit. So it would take 6 years to get your investment back. But you are hoping for an appreciated stock as well. And in order to get a lower PE, a few things have to happen. And when a price of stock goes down, your PE goes down because P is the numerator of the equation. And when you raise your net income, your PE also goes down. And another popular thing that we've seen a lot is companies buying back shares. When you lower the shares outstanding, it also lowers the PE and it makes it look more attractive. So you may feel, oh, this PE is really, really good, but it might be the result of companies buying back all their stock and kind of manipulating the numbers. Price to sales ratio, I like to see under 2.2, but this varies by industry. That's just price of stock over sales per share. And this could also be manipulated by stock buybacks and other types of things. But when this number is low, it generally means an undervalued stock. And when it's high, it means an overvalued stock. But the downside of this is that it doesn't take into account earnings. So you might have tons of sales, but if you can't convert that into actual profit, if it's all going back out the door in expenses, doesn't really benefit you too much. And price to book, this is a really low price to book, 0.5. It's a stock price over the book value per share. And remember, book value is just your equity, which is the same as book value. The value of your company according to the balance sheet. So I like to see under 3.3. Certain firms just have really low book value, so it's not as easy to compare. But you should always compare ratios, see this note, to companies in the same sector. That's the only way you know if the company has good ratios. Because it may look good, but then when you compare it to its competitors, it doesn't look so great. You can't compare it to Apple, this stock, because they're going to have way different ratios because they're a different company. They have a good current ratio. That's current assets over current liabilities, and that's just your short-term liquidity. It's how much money you have to pay your daily operations for next year. And if it's under 1, that means you don't have enough money to run your business and you have to borrow more money. 1.2 to 2 is ideal. The return on equity is the income, net income, which we input earlier, profit loss, over equity, the equity per share. And I like to see above 20%, but as you can see with REITs, it rarely gets that high. Only one REIT has over 20%. So some numbers are not as applicable in certain sectors. So now that I've done a lot of REITs already, this is my 7th REIT I modeled out, so I have a little more information in this video. So this is all the ratios over here, and then the REITs, the ticker is up here, and then the winners, who has the best ratio. So TRTX doesn't win in anything, but that doesn't mean it's bad. It might have a good ratio and everything. So let's see. We want a low PE, and TRTX fits that category. It's a low PE. The only three bad ones are AMT, BHR, and Stag. They have pretty high PEs. But you have to look at the whole picture, of course. And then TRTX has an okay price to sales. WMC has a solid price to sales. MFA and BHR does as well. Price to book, I think most REITs have a pretty low price to book. AMT is really high, the price to book, and I'd be interested to delve into the balance sheet a little more to understand why it's so high compared to the other REITs. I'm sure it would make sense once we looked at the balance sheet. And then the current assets, current ratio, that's it should be under between 1 and 2. And TRTX and WMC and MFA are great. AMT and BHR is not good. That means they can't even fund their day-to-day operations. They're going to have to borrow money. They don't even have enough assets to cover their short-term liabilities. And STORE is a little too high. They don't need that much cash on hand. And ROE, you can see they generally don't have good ROEs, except AMT has a really good ROE. So it's interesting, AMT. It looks like they have a different business model. But that's the analysis on TRTX. Let me know what you think in the comments if you wanted to see more details or information. But thanks for watching.